Joining us is a very interesting mind on markets. Mr. James Perry is the founder of Perry International Capital Partners, former Chicago guy as well. I guess now you split your time between Miami and Chicago, right, James?
Correct.
Tell me about your background. You were at PGIM prior. You have experience at Arbor as well, which is shop of Jim Bianco. I think a lot of folks know from Chicago. You were at HSBC. You were in London. You're a bond guy originally. Give us your kind of 60-second background.
Very simply, out of school, the only job I got was on a trading floor as a trader, as a trainee.
Yeah.
It stuck, and I really liked the global macro from the very beginning. Took a lot of finance classes and enjoyed just knowing the numbers behind everything before anything else. I didn't like the story. I liked the skepticism and the insight that pure numbers give you. So I'm a math guy, and the idea in math is there's one right answer. There's not two. So to me, it was always about global macro, central bank liquidity, where interest rates going, because interest rates drive everything.
Okay. Right now, there's kind of an interest rate conundrum because the markets are saying right now, CME futures are over 80% we're going to cut. But I'm watching the dollar kind of steadily climb over the last couple of months. And usually that dollar doesn't firm up if the Fed's going on some big cutting spree. Or what do you think?
That's right. Well, there's the saying in bond land that the FX market gets it first, right? So if the dollar's moving up, that means the FX traders are thinking the odds of a rate cut are slimming down a little bit. Now, I know the SOFR futures are 80% or 75% or something like that. You got to remember who trades that stuff, right? It's all the big banks. So they want cheaper money. And I think in a way, if you look at where the Fed funds rate are and you look at where the economy is, on the surface, it seems absurd to cut rates, really. Like if you just think about it, stocks that are all-time highs, housing market all-time highs, automobile prices all-time highs, unemployment 4.1%. The economy seems on the surface to be
pretty solid,
doing pretty well.
Household wealth more tied to stocks and risk assets than ever.
Private wealth in this country, Oliver, are $170 trillion. Think about that for a second. GDP is 30, right? All that wealth is private wealth, and anybody that owns an asset has been a beneficiary of inflation for the last 14 years, right? So the S&P is up, 16.5% per year for 14 years? That's unheard of. That's all about money.
I guess the flip side would be then is what kind of the argument is why not loosen the real rate if inflation's though also coming still down off the peak and has settled at least. Do you have to have a real strong view that inflation's going to flare back to not want to cut just to kind of be safe at this point?
Inflation is a tricky subject for a lot of people. Sometimes people misunderstand it. They think about eggs and then they think about insurance. Two different things, right? Goods inflation has been coming down since the pandemic. That's clear. They continue to come down, which is surprising a lot of the people that said tariffs are inflationary. They have not been to date. Maybe they will be, but...
Do you think that's an easy equation to figure out or no?
I think that most of the Christmas buying season, which is basically 50% of retail profits, right? All of that stuff's been bought for 6 months. It's here. So I think you're already looking at Q1 sales, and the prices right now have really essentially been unchanged in basic consumer discretionary stuff. Christmas presents, birthday presents, things you don't need. But the problem with inflation is the government is the only root cause of inflation. It's fiscal deficits, right? And I think that this big, beautiful bill, it would have been really nice for bond traders to see some cuts in spending, and we didn't get them. National debt's still banging up against 38 trillion. The budget deficit is 2 trillion, right? I mean, the government brought in $5 trillion worth of revenues and spent 7. Pre-pandemic, they brought in 3.5 and spent 4, right? So you're talking about a fiscal deficit that's quadrupled in 4 years, right? This is the problem. It has not been addressed.
What's the time frame we need to run that correlation? Because the counterpoint would be, to your point, we've been spending nonstop, whether it's this guy or the last guy or him before.
Right.
And we seemingly can trace that inflationary big up and down, one could argue, to some of that supply chain shock.
For sure.
If the inflation chart doesn't correlate directly with the deficit and the debt chart, then do we go, hey, maybe this stuff is, or is it just lingering like this quiet beast that has some asymmetry to it at some point?
Right. The problem is the size, right? I mean, it's been growing and growing. The good thing about the bond market right now, 10-year yields were at 380 in January. Now they're 480. They're 4.25 right now, right? 4.25, 427 today. But they've really been going sideways for 3 months, 6 months, right? And they're still about 100 basis points higher than the pre-pandemic level. So that risk premium for this deficit spending and national debt is being built into the market. If the government did cut spending and reduce the national debt in the last 3 months, you'd probably be at 3.5% and a 10-year yield now. You're not because of that, right?
So it could be even more reduced.
It should be, right? Sure. Goods inflation has been coming down, and the world is deflating. I mean, India is exporting deflation. China is exporting deflation. These are the two biggest countries in the world, right? Yeah. So they need to continue to produce and cut costs to do it because their marketplace is here. That's why tariffs are not inflationary. But service inflation is really about the cost of money. And, everybody who owns an asset, house, pension, stock market, they're doing great.
Sure.
But what about that cohort, that sort of young group of kids, sort of 35-year-old kids, 25 to 35-year-old, who are shut out of the housing market?
Sure.
Why? Yeah. Mortgages are at 6.5%.
Yeah.
They should be at 5.5% or 4%. Housing market would pick up. They're not, because the cost of money is too dear. And if the Fed cuts interest rates from 4.5% upper bound to 4.25%, are mortgage rates going to go down? Probably not, right? Yeah. There's a credit spread there, right? So more people are getting more mortgages.
When the Fed started cutting, yields went up.
Right. So mortgages aren't necessarily going to go down no matter how much Trump tries to push the Fed into doing something that they really don't want to do.
Right. In some ways, it has that kind of blowback effect if it ends up inflating asset prices further or supporting, juicing the economy.
Exactly. The biggest problem, the reason we have a new administration, is that middle class, their cost of living has gone up 30%, 40% in the last 4 years. They said, please cut spending. We are getting killed, and there's no way around it. And the government didn't do that in the last month or so, right? So they think, okay, and Scott Bessent's a pretty smart guy. I have a lot of time to listen to him and a few other guys in the administration, but he's trying to argue that the government would really appreciate lower rates because it would help everybody. Well, it doesn't work that way, right? Markets set the prices. So to me, it seems like the only way real service inflation is going to go down is if government spending and national debt actually has genuinely, there's an effort to reduce it.
Now, when you look globally, because I know you have experience, you think global, you think big picture, a lot of this stuff that seems like it might be this overhang or threat here, you look around the world and it's like, well, what's your better option? I asked the AI for a geopolitical trade, something international. I wanted to get your thought on it here as we consult the machine to try and come up with some ideas. That's not me, by the way, even though it looks like me. I said, what's a geopolitical trade to carry into the end of the year, and how can you execute it simply? Response says the headlines scream war risk, but the smarter angle is fiscal inertia. Once defense budgets rise, they rarely shrink. So this trade is actually going on kind of the defense side. While Europe's industrials face higher energy costs and contracting exports into winter, that sets up a relative trade. Long U.S. defense contractors, short European cyclicals, buy U.S. aerospace and defense ETFs, paired against short exposure to European industrials. Forget the war talk. The real signals in the budget math. So this is kind of a little bit of a contrarian trade to what people were doing earlier in the year to some extent, I feel like, about the whole NATO funding and stuff. What do you think?
That's right. Spending is a problem everywhere, right? I mean, the biggest difference between the United States and Europe, for example, is here it's individual freedoms and individual choice. In Europe, it's really the state kind of mandates things. There's a great safety net there, great safety net. But the trouble is that Europe really isn't growing, right? So the only way that they can manage the safety net is print more money. And that's why these yield curves around the world are steepening. Japan, UK, France, same thing. So here, I really think that the 5 biggest issues in this country are taxes, deregulation, government spending, trade deficit, and national security, right? So I was over in Europe, Q2, and wanted to talk about all 5 of those things.
Okay.
90% of every conversation at every meeting was about tariffs, right?
Yeah.
And when I did a video in Zurich when I was over there, and I said, man, this is an asymmetric bet. These guys are just so wound up and so angry that they're going to have to, reduce tariffs and get things back to a fair trade thing, that they can't see past the idea that there's a lot of good things going on in this country, and they should be talking about it and investing accordingly,
Right.
rather than just worried about tariffs,
Sure.
which are going to go away,
Sure.
right?
Even if you pay a higher cost on the margin goes up, but it goes domestic, then that money comes
Correct.
back around into the system in theory.
Correct. So when the downtrade in the stock market came in April, I was over in Europe, right? And I just said, this is a goofy trade. I'm not going to get involved with it because the market's going to go up.
Right.
And as soon as I get back to Chicago, I'm going to buy some more tech stocks, right?
There you go.
So Perry Capital Asset Management is having a great year because we just look at the global picture internationally. And if you just say, that doesn't make sense, that's an emotional trade. So ignore them. Investors internationally have to understand that the market trades off of different things at different times.
Yeah.
And if they get so focused on the emotional issue of the day, which they see every day in the papers and on news,
There's a lot of whiplash.
not only is there whiplash, but they're making decisions based on emotions, which are going to change. It's not reality.
Yeah. The AI trade doesn't have emotions.
Right,
It's
right.
just pure tech.
So the AI response that we just got here is very similar to the one I have. You
Right.
know, I have a S&P 500 fund, basically beat the S&P every year with less risk. So I overweight asset allocation in different sectors. I'm overweight tech and defense stocks,
Okay. There you go.
and underweight REITs and healthcare.
Okay.
And guess who's winning? Me. Why? I mean, that trade, it's not just me. It's been a pretty easy year to invest, in my opinion. But the point is, you have to be selective on what's happening in different sectors of the economy around the world to make proper investment decisions.